Welcome to the Bullion Signal Podcast. We're the channel that cuts through the noise to look at the big picture, macroeconomics, precious metals, and how you can protect your wealth in an uncertain world. Today, we're diving into a story that connects two worlds you probably never thought were related: the explosive growth of artificial intelligence and a looming crisis in the physical world of resources. You see, something strange just happened in an AI company's earnings report, and it's a massive warning sign, a signal that the digital revolution is about to collide with a very hard, very real physical limit. So stick around, because what you're about to hear is a story the mainstream financial news completely missed. And if you find this analysis valuable, make sure you're subscribed to the Bullion Signal podcast so you don't miss our future updates. It all starts right here with this quote. Picture this. It's an earnings call for the tech giant Oracle. The AI boom is in full swing, and investors are expecting to hear about massive growth. But then the CEO, Safra Catz, says this. She admits they couldn't build out their cloud infrastructure as fast as they wanted to. And the reason she gave wasn't a lack of customers, it wasn't a shortage of their advanced computer chips. No, the problem, the constraint, was power. They literally couldn't get enough electricity.
And that really is the million-dollar question, isn't it? Why would a major tech company, right in the middle of what people are calling an AI gold rush, suddenly hit a physical wall? This isn't just about one company's quarterly report. This is a canary in the coal mine. It signals a much bigger, much more fundamental problem that goes way beyond Silicon Valley and has huge implications for the entire global economy. So let's start by digging a little deeper into this Oracle situation. The first clue is hidden away in their Q2 2025 earnings report. On the surface, it looked like a pretty standard story of missed targets. But the real story, the important story, was what was happening behind the numbers.
You see, this is the great disconnect. Wall Street analysts looked at their spreadsheets and saw missed revenue goals. They concluded that maybe Oracle's cloud business was slowing down. But that wasn't it at all. What was really happening was a problem of physics, not finance. Oracle couldn't deliver because they physically could not plug in enough servers. They couldn't get the juice needed to power the very AI systems that customers were lining up to buy.
And this brings us right to the heart of the matter. The great unseen bottleneck of this entire AI revolution isn't silicon, it isn't software, and it isn't money. It is the humble, aging, and completely overwhelmed electrical grid. It's the simple ability to get power from where it's made to where it's needed.
To really grasp the scale of this problem, you have to look at the building blocks of AI. This is an NVIDIA H100 chip, pretty much the workhorse of the modern AI world. A single one of these little things consumes 700 watts of power, and that's not its peak power. That is its constant, around-the-clock, never-sleeping power draw.
So what does 700 watts actually feel like? Well, imagine taking 7 high-end gaming computers, the kind with all the flashy lights and powerful graphics cards, and running them at full throttle, all day, every day, forever. That's the energy thirst of just one of these AI chips. Now remember, a single AI data center contains tens of thousands of them. You start to see how the numbers get insane, really, really fast.
And here is the fundamental crisis, the collision course we're on. The digital world of AI is moving at a blistering pace. Its capabilities are literally doubling every 6 months. But our physical world, the world of power plants, transformers, and transmission lines, moves at a snail's pace. It takes, at a minimum, 5 to 7 years just to get the permits and build a single major grid upgrade. These two timelines are not just different, they are fundamentally incompatible. It's a train wreck in slow motion.
So, as you can probably guess, this is not just an Oracle problem. We have officially entered a global power scramble. It's a frantic race against time, and almost every single major technology company has slammed headfirst into the very same physical wall, all at the same time.
Just look at the players. You've got Microsoft, which is planning to spend over $50 billion on new data centers. You have Amazon's AWS. You have Google. You have Meta. You have Elon Musk's xAI. It's a who's who of big tech. And they are all in a desperate, high-stakes competition for the exact same extremely limited resource, grid capacity.
So what do you do when the public grid simply can't keep up with your demand? You try to build your own grid. You try to become independent. And the only way to do that is with massive energy storage systems. The entire industry is now in a desperate search for a holy grail: advanced, large-scale batteries that can store huge amounts of power right there on site.
And this is where our story takes a very sharp and, for us, a very important turn. We're about to connect the dots from the high-tech world of AI data centers to the gritty, old-world market of industrial metals. Because this search for a battery solution reveals a hidden link, a direct connection between the AI revolution and a very specific precious metal, silver.
Now, when you think of big batteries, you probably think of the lithium-ion batteries that are in your phone or in electric cars. But for a data center where you have thousands of servers packed together, the fire risk from lithium is a massive, massive concern. So the industry is increasingly looking towards safer, more stable, and more scalable battery chemistries. And one of the most promising technologies is based on a different metal entirely. The key here is zinc.
To understand what happens next, you need to understand this one crucial concept, the byproduct metal. It's a simple idea. It just means that it's a metal you don't usually mine for directly. Instead, you get it as a bonus while you're mining for something else. Think of it like this. You're mining for copper, and you just happen to find some silver in the same rock. The silver is the byproduct. And this is the key to the whole story.
Because here is the shocking fact. A staggering 70% of all the new silver that comes out of the ground each year isn't from dedicated silver mines. It is a byproduct of mining for industrial metals like lead, copper, and, you guessed it, zinc. Let that sink in. This means that the world's silver supply is not determined by the silver price. It's almost entirely dependent on the demand for industrial metals. So when the AI industry starts demanding huge amounts of zinc for their new data center batteries, it has a direct, unavoidable impact on the world's silver supply.
Now let's zoom out, because this brand new, massive demand for zinc, and therefore silver, from the AI industry is crashing headlong into a silver market that was already in serious trouble. The world had a major silver supply problem long before the first AI chip was ever designed. Even before the AI boom, demand for silver was absolutely exploding. You've got the green energy revolution, with solar panels needing huge amounts of silver. You've got electric vehicles, which use more silver than gasoline cars. You've got the 5G network rollout. All of these massive global trends are incredibly silver intensive. The new demand from AI data centers isn't just a small addition to the market. It's like pouring jet fuel onto an already raging fire.
And the numbers are just jaw-dropping. This year, the world is expected to demand about 1.3 billion ounces of silver for all its needs. But global mine production? It can only pull about 840 million ounces out of the ground. That leaves us with a structural deficit, a shortfall of nearly 500 million ounces in a single year. We're covering that gap by draining our above-ground stockpiles and inventories, but those stockpiles are finite, and they are depleting very, very quickly.
The logical question, of course, is, well, why don't we just mine more silver? And the answer is that physical reality is a tough master. You can't just flip a switch. First, as we said, 70% of it is tied to mining for other metals. Second, the quality of the ore in the ground has collapsed. In 2005, you'd get about 15 ounces of silver for every ton of rock. Today, you're lucky to get 4. You have to move almost 4 times as much earth to get the same amount of metal. And even if you find a fantastic new deposit tomorrow, it can easily take 10 to 15 years just to get the permits approved to build a new mine. The supply side simply cannot respond quickly.
And this brings us back to that fundamental disconnect we started with. Financial markets live in a world of spreadsheets, software, and quarterly earnings. It's a world of abstractions. But the real world, the one that underpins everything, is a world of physical reality. It's constrained by geology, by engineering, by physics, and by power grids. And that physical foundation is now showing deep, deep cracks.
I think this quote sums up the entire situation perfectly. The digital world feels infinite. In theory, you can scale software forever, but it's built on a physical world that is very, very finite. You simply cannot program your way out of an electrical power shortage, and you absolutely cannot deploy a software patch to a silver mine that is running out of ore.
And so that leaves us with this one final massive question. What we are witnessing right now is a historic collision between the unstoppable force of digital innovation and the immovable object of physical reality. When a revolution built on bits and bytes meets a hard limit set by atoms and electrons, which one breaks first? I think we're all about to find out. Thanks for joining us on the Bullion Signal podcast. If this analysis gave you a new perspective, please hit that like button and be sure to subscribe so you're ready for our next deep dive. And finally, a quick disclaimer. This podcast is for informational and educational purposes only. It is not financial or investment advice. You should always do your own research and consult with a professional before making any investment decisions. You alone are responsible for your own choices. We'll see you next time.